Seth, Isaac, Michael, what's going on, guys?
Good to see you.
How's it going?
Good. Okay, looking forward to having this quick little mini dive into the state of the multifamily market in the Bronx right now. And I want to dive in right on a subject that always occurs in New York City, which is there are a certain amount of buildings that are listed and that are publicly listed. They're listed with brokers when someone wants to sell. And there is always a percentage of the market in New York, and particularly in the Bronx, that they're not listed, but they're still for sale. You can call it the open market, the shadow market, or whatever. We were just talking about this, and what are you noticing relative to this subject right now, Mike? Because I think this is a big theme that's happening in the Bronx right now, and there's going to be a lot. We'll get into the reasons why, but what are you noticing?
Yeah, that's a good question. It's definitely a theme that we see in the Bronx. I think if you're gonna put a number on it, I don't know an exact percentage per se, but I would say at least 50% of the buyers that we're talking to, and 50% of the sellers that we're speaking with, they want a more controlled process, and they're saying, hey, go to 5 to 10 guys, keep it quiet. We want to keep it closer to the chest. We're real. We want to transact, but we don't want to broadcast it to the whole entire market. Because they identify and they see in the market that there's a group of buyers that you can call the actives, right? That are actually putting in real bids.
Yep.
Then you have a group of buyers who are way off the mark, offering 7.5, 8 caps. That's not going to get a deal done.
Yeah, that's not where the market is. But exactly. I think if you jump into this, what I pick up from that is that there's the sellers who are basically want to sell but don't want to list. It's because they don't have confidence yet in the certainty that things are going to trade right now, given where the market is, right? Seth, how would you comment on that?
I would say that I think a lot of people are confused as to what to do. There hasn't been that much data in terms of comps because the velocity has been so diminished over the last 6 months as a result of COVID. So I think that, people are confused. Like, what is the pricing? I think a lot of people are still trying to figure that out. Since March, we've closed about 20 deals in the city, and we have about another 20 under contract. So we feel like we have a pretty good sense. There's little nuances to every building and, where it's located, how the taxes are impacting the cash flow of the building. So, everything's a little bit different, but I think a lot of people are still trying to figure out their plan.
Right.
I had lunch yesterday with a client who owns, he's almost 60 years old. He's been in the market for 25 years. He goes to the buildings a few days a week, and he's like a hands-on type of guy. And he doesn't know what to do. He's like, I'm confused. My kids don't want the real estate. I'm tired. I've been doing this a long time. I don't really know what to do.
Right.
Well, I think you're seeing that play out a lot with a certain group of owners. And I think that's a big percentage of the ownership group, like that age group, that demographic, that clientele. And I think you're going to see over the next, 12 or 18 months as the market, really solidifies itself. And I think we're going to stay in this, general place, if you will, for a while. And I think you're going to see that type of client start to make some bigger decisions.
Right. Well, what I think we've seen is that the amount of this open market, or the shadow market, if you will, of owners who want to sell but just haven't listed, that number has grown by probably 3 or 4 times what it normally is. Wouldn't you say, Isaac? Is that what you're seeing?
Yeah, definitely. And just kind of circling back to the uncertainty piece, I think that's a huge part of it, because whether they're uncertain about the price that they would transact or just the market in general, or if it's the right time, it's a lot easier for an owner or a seller to say, look, here's 2 buildings out of the portfolio. We're not going to list it. We're not going to go through this whole process, but take it to your top 4 or 5 and we'll see what we can do.
Yeah, they just want
It's,
they just want
mentally it's easier.
they want execution, right?
Exactly.
It feels very similar to what happened after the rent laws got passed. The lull in the market, people were on the sidelines. Some people were identifying themselves as saying, hey, I'm either going to place capital out there, or I'm going to put my building on the market and see what the market can yield. So, what we learned after June 15th is going into Q1. I mean, Seth and Isaac, you could speak to this as well. Going into Q1, the deals that we had on the market and what our pipeline looked like going forward, I mean, it opened up after the rent laws. So I think that, generally speaking, we were on this call, 60, 90 days ago. A lot has changed in that 60 to 90 days.
Right. Yeah.
Yeah, it takes people about 6 months to adjust, reset their expectations and figure out their plan.
Mm-hmm.
Yep.
So, so you basically are saying that you see in the past 90 to 120 days that they're starting to become you're taking steps. It's not there by any means, but there's taking steps towards a market equilibrium where the market knows where pricing is. But let's talk about operations a little bit. Mike, the big talk in the beginning of this whole chain of events was in neighborhoods such as the Bronx was collections. What if you had to compare where we are now to the start or the first phase? What are owners reporting to you relative to collections now?
Yeah, it depends how you're looking at it, whether it's on the commercial side or the residential side. On the residential side, there's definitely been an uptick in the percentage of collections that are being reported. In the beginning, there was, and when we first spoke about this, there were a lot of unknowns. We were really in the ballpark of, in some cases 60, 70, 75%. And now, being boots on the ground and talking to owners every single day, you're more in the ballpark, depending on the integrity of how you manage your property and the tenant base and where you're located. You're upwards of 85, 90%.
Right.
Depending.
So collections are improving.
Oh, 100%. Yes. Yeah. On the retail side, that's definitely still struggling.
Yeah, that's a whole different.
Yes.
That's a horse of a different color.
Mm-hmm.
What else as far as operations, Seth? Like what else are you noticing, or what's the chatter in the market about operations?
The chatter in the market is about little nuances on the expense side. Everyone talks about the property taxes, the insurance, and the water, and all those are going up. But I think those are like the big ticket items, if you will. But every piece of legislation and every new bill is a form of regulation that has a cost to it, and they're not getting rid of these; they're adding to these. So the expenses are going up, and these are just like little paper cuts that buyers are really starting to underwrite a lot more closely than they did, 12 or 6 months ago. It was, you can't control the top line income anymore as much as you used to. So you have to control the bottom line. And that means really accounting for every expense to the best of your ability.
Yeah. Well, the whole thing, our whole conversation about certainty in the market, I think what is challenging for owners relative to what you say with regulation is it's just out of their control. So it's an expense that's put on them that they have no control over.
Correct.
Right. And very, maybe if you have a bigger organization, you can limit some of the expenses, but there's very little you can do, and it really impacts the bottom line.
Yeah,
absolutely. All these new things about coming out, gas pressure, lead paint, the pointing, the violations. You send an inspector in to take off violations, they add 5 more. I mean, all these things they add up.
Yeah. So those are contributing to those are the obstacles that people have to navigate right now. And how would you say that's impacting who's selling? Like how is that kind of adding to or determining who is deciding to sell now?
Right now, it seems like it's mostly the smaller private clients
Mm-hmm.
with low debt levels.
Mm-hmm.
I think, this has been the theme, really since the rent laws changed a little over a year ago. You're seeing people. This kind of goes back to what I said a few minutes ago about that demographic of people who are, closer to retirement age, looking at how they're realizing that this isn't really changing drastically for the better in the near term, and they're looking at their life and they're thinking, do I want to be doing this? Can I be doing something different? And they're cutting the cord, and I think it's a lot easier for people to do that if they have very low debt levels,
Right.
and that's the longer term owners, the smaller private clients.
Right. So those are your discretionary sellers. What we're seeing is there's another category that's starting to emerge, and I think over the next 12 months that will play out, that are non-discretionary. And Isaac or Mike, do you want to talk about what we're starting to see in that category? And it's mainly based on when you bought and how high your debt is.
Yeah, I think the other, you could say, bucket of seller is the larger players per se, who have been in the market for a while. They're looking to take a few chips off the table, identify a few assets in their portfolio that they might be able to reposition and reallocate the capital elsewhere, whether it's through investing in something passive like a triple net leased asset, or a lot of these guys and some people who we've sold for, and some clients who we sold for recently, they have holdings in Florida, Texas, and the Carolinas, right? So they're redeploying the capital there.
Mm-hmm.
So it's really taking in a snapshot of the portfolio, identifying, okay, there are 5-6 buildings that we can definitely get rid of to thin it out.
Mm-hmm. Yeah. Isaac?
Nine times out of 10, circling back to Seth's point, it's like those are the buildings that have low debt. They're not going to have to come out of pocket after they close or anything like that. And the biggest thing that I've noticed just in my conversations is, again, circling back, we had this conversation 90 days ago, Peter and Mike, but the people that just don't have the mental bandwidth to outlast whatever is kind of this next phase. It's going to get better.
Yeah.
It's New York City, let's be honest, but you have to look at your timeline, your mental health, essentially.
Yeah.
And I think that ties right into the people that are actively bidding on stuff.
Yeah.
I think that's a perfect segue, and it's pretty indicative of the profiles of who we're dealing with on a daily basis right now.
Yeah. So when you think about that, looking ahead for the end of 2020, right? We had talked about the market on the buyer side and the seller side bifurcating, essentially.
Yep.
Seth, what are the two groups you see kind of on the buyer side, and the two different types of sellers, two different types of buyers, two different types of sellers?
The buyers seem to be almost exclusively private families, long-term mindset. No, they're not looking at a spreadsheet for their IRR return. There's no set time limit of when they should sell it. It's really just I like the address, I like the building, and I'm prepared to own it for over 10 years. I'll raise some money from family and friends if needed, but there's no institutional equity behind them. That is an overwhelming majority of the buyer profile today.
Mm-hmm. Mm-hmm. And then on the sellers, like we talked about, like there's bifurcated sellers. Mike, what's your thoughts there? There's kind of there's two types.
Yeah, there's like you said, it's completely bifurcated. It's either I'm on the sidelines, there's too much political uncertainty, there's too many capital events that are coming into play. You have an election looming in November. So a lot of people are just on the sideline and waiting to see what happens with coronavirus and the election. Mm-hmm. And they're just not doing anything. They're just sitting and watching.
Mm-hmm.
On the other side, you have people who are saying, I'm getting out now, and I'm getting out as fast as possible because X, Y, and Z is happening, and
Right.
I don't think it's going to look good, right?
Yep.
So you have two groups where there's really no middle ground. It's
Yep.
you're either here or you're here.
Right.
And that's it.
Yeah. And then I would say even further within this, in that group that's deciding to sell, you have the ones that are deciding to sell by choice because they don't, you know, they like, you know, like Isaac said, they don't have the mental bandwidth or just the desire to do it. And then you have other ones, you know, I think, you know, to be very macro about it, that if your debt levels are over 65 to 70%, and you're dealing with some of the challenges that you're having operationally, you know, you have to look and say how, you know, our cash flow is getting very thin, or maybe we're even, you know, supplementing the building a little bit at this point, and how long do we want to do that for? And that's a different kind of conversation that we're starting to see to come to the market too. So, well, Seth, Isaac, Mike, we keep these mini dives into a market pretty short, but thanks a lot, guys.